Right now, in South Africa, there are entrepreneurs running multi-million rand businesses who are literally one lawsuit away from personal bankruptcy. And the crazy thing is, they have absolutely no idea.
None at all. It's actually terrifying when you look at the numbers.
Right. They are walking a financial tightrope without a net. I mean, you've got these founders who have spent decades building up their wealth, yet they own these highly valuable assets in their own personal names.
Yeah, their trading companies are holding the physical assets.
Exactly. And they routinely sign personal sureties for business loans. They are just completely mixing their personal liability with their business liability.
It is an incredibly precarious way to operate because when we synthesize the strategic documentation we have today on charitable trusts for business owners, and we look at that alongside the expert methodology of Limke Sturman.
She's a premier South African trust consultant, right?
Yeah, exactly. A highly respected consultant in this space. And when you blend those two sources, a really stark warning emerges. It only takes one unforeseen event, just one lawsuit, one unexpected business liquidation, or, one aggressive SARS audit to just wipe out a lifetime of work.
Wow.
Because when your personal identity and your business entity are totally tangled up together, a fatal blow to the business becomes a fatal blow to your personal financial survival.
Okay, let's unpack this, because that is the terrifying reality we are tackling today. If you are listening to this and you spent the last decade building a successful enterprise, today's deep dive is really about the ultimate shortcut to financial security.
And lasting legacy.
Right, lasting legacy. We are exploring the architecture of what the sources call the asset protection fortress.
I love that term.
It's a great visual. It's basically the science of separating your personal wealth from your business risk, and then, figuring out how to deploy that wealth to literally change the world around you.
All while securing massive tax advantages, which we will definitely get into.
Whoa, we are definitely getting into the tax breaks. But before we can talk about leaving a grand legacy, we first have to secure the foundation, right?
Absolutely. You have to protect what you already have. The fundamental rule of the wealthy-like, the core principle that really separates the truly insulated rich from the vulnerable entrepreneur, is this distinct separation. The company carries the risk, but the trust owns the assets.
The company carries the risk, the trust owns the assets. Let's explore the actual mechanics of that. Under South African law, what actually happens when you establish this structure?
So a trust is a really unique legal arrangement. As the founder, you take your assets and you transfer them to trustees.
Okay.
Those trustees are then legally bound to manage those assets for the beneficiaries. But the crucial mechanism here, the really magical part, is that this process completely severs your personal ownership from your legal liability.
So I don't own it anymore.
Exactly. You no longer legally own the asset. The trust does, as its own separate legal entity.
Think of it like this, to use a visual analogy for you listening. Think of your business operations as the battlefield outside a massive castle.
Okay, I like where this is going.
Right. So that battlefield is where all the trading happens. It's the risk, the hiring, the firing, the market volatility. It's chaotic, and it's exposed out there.
Very exposed.
Now, the trust is the reinforced, impenetrable keep right in the dead center of the castle. Even if the battle goes terribly wrong, say the outer walls fall and your business is forced into liquidation, the treasure inside that keep is legally untouchable by the invading army of creditors.
Right. They can seize the battlefield, but they cannot breach the keep.
Exactly. But wait, if I take my hard-earned money, or I don't know, my property portfolio, and I transfer it into a trust, don't I lose control of it?
That is the million-dollar question.
Because from a business owner's perspective, handing over the keys to the kingdom feels totally counterintuitive. How is it still mine if I've handed it over to this separate keep?
Yeah, that hesitation is incredibly common. And the answer lies in the strict separation of control that's required by South African law. You do not entirely lose influence.
Because you could be a trustee, right?
Exactly. You can be appointed as a trustee, provided the trust deed is drafted properly to allow it. You can establish the overarching rules for how those assets are managed and distributed.
But there's a catch.
A very big catch. There is a hard line you cannot cross. You cannot treat the trust like your own personal piggy bank.
Because the moment you treat that trust account like a personal checking account, like if you're paying for your groceries or your family holidays directly from it, the legal shield just evaporates.
Oof. Gone. The courts and SARS are highly, highly vigilant about this. If they look at your financial records and they see that there is no functional separation between you and the trust, they will invoke a legal concept called piercing the corporate veil.
Which sounds painful.
It is financially fatal. They will rule that your trust is a sham. And suddenly, your impenetrable keep is breached. The creditors can get right in.
So how do you prove it's not a sham?
Well, to prevent this and to maintain legal validity for family trusts in South Africa, the law typically requires at least one independent trustee.
Wait, an independent trustee, meaning someone completely outside the family dynamic.
Yes, exactly. Someone who is not a beneficiary, and they cannot be related to you by blood or marriage.
Oh, wow. Okay.
Their presence ensures the trust is managed impartially and legally. It basically serves as objective proof to the outside world, and especially to SARS, that the keep is truly a separate fortress and not just some, sophisticated hiding place for your personal funds.
Okay, so since this impenetrable keep is recognized as its own distinct legal entity, the South African government naturally treats it differently than a regular breeding person, particularly when it comes to taxes.
Oh, definitely. And the sources outline a few variations of these fortresses.
Yeah, the documentation covers living trusts, which are also known as inter vivos trusts, right? The ones you create while you were still alive.
Correct. And then there are testamentary trusts, which only spring into existence from your will after you pass away.
Right. And then you have special trusts, business trusts, and finally, charitable trusts. But looking at the tax reality of just a standard trust, it's rough.
It's very steep.
Like a 45% flat tax rate on retained income and an effective capital gains tax rate of 36%. Those are the highest tiers possible.
It's brutal.
It really is. So what does this all mean? I mean, why would any business owner willingly choose to move their assets into a structure that gets taxed so heavily? On paper, it sounds like a terrible financial move.
What's fascinating here is the mechanism that makes it viable. It's called the conduit principle.
The conduit principle. Okay, explain that.
So that 45% flat rate, that only applies to income that is retained, meaning income that is earned by the trust and just sits there, accumulating inside the trust's bank account at the end of the financial year.
Okay.
But South African tax law allows the trust to act merely as a conduit or, a pipe.
So if the trust is the pipe, and the money flows entirely through the pipe down to the beneficiary within that same tax year, the pipe itself isn't taxed.
That is the exact mathematical advantage. Let's use real numbers. If the trust generates R100,000 in rental income and retains it, SARS takes R45,000. Right. But if the trust distributes that R100,000 to a beneficiary whose personal individual tax bracket is, let's say, only 25%, the tax burden is drastically reduced.
Ah, I see.
The income retains its original nature as it flows through the trust, and it is taxed at the individual's lower rate.
Okay, that makes sense for managing family wealth and, mitigating standard tax burdens. But there is a specific vehicle detailed in our sources where the tax script flips entirely in the business owner's favor.
This is where it gets really exciting.
It is.
Yeah.
Moving from the defensive play of just protecting wealth to the offensive play of strategically deploying it.
We are talking about the charitable trust.
Yes. The charitable trust. And this structure isn't designed to benefit your family members, right? It exists exclusively to serve the public.
Exactly. It focuses on pillars like poverty alleviation, the advancement of education, healthcare, or, environmental conservation.
Which is so powerful because it takes ad hoc generosity like writing a check for a local sports team or dropping money into a collection tin, and it transforms it into an institutional powerhouse.
And to unlock that power, a charitable trust must be rigorously structured to obtain PBO status.
That's public benefit organization status, right? Under Section 30 of the Income Tax Act.
You got it. And beyond just PBO status, the absolute holy grail here is securing Section 18A status.
Section 18A, the golden ticket.
The tax advantages attached to Section 18A are just staggering for a high net worth individual.
I mean, let's list them off because they're insane.
Yeah.
If your charitable trust achieves this, it pays zero income tax on receipts and donations.
Zero.
Zero capital gains tax when disposing of assets. It is completely exempt from the normal 20% donations tax that usually penalizes large transfers of wealth.
It's massive.
And upon your passing, any bequests you leave to this trust completely bypass the standard 20% or 25% estate duty.
It basically creates a massive impenetrable shield around the capital. It allows 100% of the funds to be directed toward the actual charitable cause rather than being diluted by taxation at every step.
And here's where it gets really interesting. The source text outlines a virtuous cycle here that is absolutely vital for you as a business owner to understand.
Walk us through it.
Okay, let's say your company is highly profitable. You establish a charitable trust, and you endure the rigorous process to get that Section 18A approval.
Ah,
You, in your personal capacity or through your business, can now donate money to your own charitable trust.
right.
Because of that 18A status, you receive a tax deduction of up to 10% of your personal taxable income.
Yes.
So you're actively reducing your personal tax bill, but the capital isn't disappearing into the national treasury. It is fully funding a charity that you established and that you control the strategic direction of.
It is a profound alignment of financial incentives and social impact. You are legally redirecting funds that would have inevitably been lost to the tax base.
Right.
And you're keeping them within a structured, highly regulated entity dedicated to social upliftment that you oversee.
But wait, SARS isn't naive. I mean, if I set this up, isn't SARS going to view this as just a clever tax dodge? How do you prove it's real and not just disguised philanthropy?
The governance requirements are deliberately unforgiving for that exact reason. You cannot simply declare your trust a charity and start claiming massive deductions.
Obviously not.
The objects of your trust, meaning the stated legally binding goals in the founding deed, must fall strictly into recognized statutory categories.
Like healthcare, education, that kind of thing.
Exactly. And the ultimate failsafe is the dissolution clause.
Oh, right. The dissolution clause.
That is what truly satisfies SARS. Because if you decide you no longer want to run the trust, or if it runs out of funds and dissolves, the assets remaining inside it cannot, under any circumstances, revert back to you, your business, or your family.
Wow. So where does the money go?
By law, those remaining assets must be transferred to another approved PBO with similar objectives, or directly to the government itself.
That is a serious commitment.
It is. That irrevocable permanence is what guarantees that this is a genuine philanthropic vehicle, not just a temporary parking spot for untaxed wealth.
Okay, let's look at what happens beyond all the legal paperwork, because the tax advantages are just the engine, right?
Yeah.
The actual vehicle is what fundamentally changes South Africa.
Completely.
And the sources provide some really inspiring, tangible examples of this architecture in action.
Yeah, Mr. Dlamini's case is a perfect illustration of institutionalizing giving. He built this massive logistics empire over 25 years.
Right, he grew up in a township.
He did, and he always valued education, made informal donations throughout his career. But in his 50s, he formalized the process. He established the Dlamini Educational Trust with an initial capital injection of R5 million.
Which is incredible, because instead of just handing out cash when asked, the trust now systematically funds school infrastructure and tertiary bursaries.
Yes.
And the most compelling part of this setup is that his children sit on the board of trustees.
Which brings a completely different dynamic to family wealth, doesn't it?
It really does.
And then we examine Dr. Naidu's strategy. After 30 years of practicing medicine, she sold her share in a specialist practice, realizing a massive liquidity event.
Right, a huge payout.
Exactly. Rather than absorbing the maximum tax hit on those proceeds, she channeled the funds to establish the Naidu Healthcare Trust, focusing entirely on rural primary healthcare.
And her approach to the mechanics of the donation is brilliant.
It really is.
Because she didn't just dump the entire lump sum from the practice sale into the trust in year one.
Why not?
Well, because the Section 18A deduction is capped at 10% of your taxable income per year. So a massive single donation would mean losing the tax benefit on anything over that 10% threshold.
Ah, right.
So she structured the donation over multiple years. She staggered the capital injection to maximize her tax deductions annually, while using her deep medical expertise to partner with rural clinics, making sure the money was deployed effectively.
It's so smart. And we see a similar scaling effect in agriculture with Mrs. van der Merwe.
Oh yeah, the Environmental Trust.
Yes. She established the van der Merwe Environmental Trust to fund conservation efforts on working farms. By securing Section 18A status, she created a centralized hub.
Right.
She was able to bring other neighboring farmers into the fold, allowing them to make their own tax-deductible donations to her trust.
She effectively crowdsourced the funding for environmental work across the whole region, all while utilizing the tax code to incentivize participation.
If we connect this to the bigger picture, the underlying thread connecting Mr. Dlamini, Dr. Naidu, and Mrs. van der Merwe isn't just tax efficiency.
No, it's bigger than that.
The true legacy they are building is what the methodology calls values transmission.
Values transmission. I love this concept. Think about the process of teaching a teenager how to drive.
Okay, yeah.
You don't just wait until their 18th birthday. Toss them the keys to a high-performance Ferrari, which in this analogy is a massive cash inheritance, and just hope they don't crash it.
Because they will crash it.
They will absolutely crash it. A charitable trust, allows your children to sit in the passenger seat of your wealth while you are still navigating.
That's a great way to look at it.
They attend the formal trustee meetings. They conduct the site visits to the rural clinics or the township schools. They see the tangible impact of the capital. They learn experientially that managing wealth requires immense responsibility and governance.
They inherit a tradition of stewardship rather than just a pile of liquid assets. You are teaching them the mechanics of the fortress, the burden of decision-making, and the importance of community engagement long before you ever hand over the keys to the keep.
Hearing the mechanics of this and the potential impact, I mean, it makes you want to draft a trust deed tomorrow.
It does.
But the sources are very explicit about the disastrous consequences of trying to DIY this architecture. There are severe pitfalls that can completely compromise the fortress and trigger massive penalties.
Oh, absolutely. The most common failure point is insufficient initial planning.
Like just using a template.
Exactly. If an entrepreneur simply downloads a generic trust template from the internet, the foundational objects might be too broad or far too narrow, making the trust functionally unworkable for its intended purpose.
And then there's scope creep.
Right.
This happens when the trust starts drifting from its original legally defined purpose. Like, if your trust is registered for educational advancement and you start using it to fund an environmental project because it sounds like a good idea at the time, you are violating your legal mandate.
And SARS will flag that immediately.
Instantly.
Inadequate funding is another common trap where the trust exists on paper but lacks the capital to achieve anything, so it just becomes an administrative burden.
Yeah.
And the fatal mistake, which we discuss regarding family trusts, applies heavily here too, treating the charitable trust as a personal asset.
The personal piggy bank problem again.
Exactly. Failing to maintain absolute separation will cost you your PBO status and trigger severe legal and retroactive tax penalties. Because while registering a basic trust might only take, 2 to 4 weeks, navigating the rigorous compliance work to secure SARS PBO and Section 18A approval, that is a complex process that takes months.
Which is exactly why the documentation introduces a highly practical solution, working with a specialized trust consultant.
Right.
Lemke-Sturman's methodology is highlighted here because she doesn't just process administrative paperwork. She architects the entire asset protection fortress from the ground up.
Engaging a professional who actually understands the intersection of personal liability, commercial risk, and tax legislation is the missing key. Her approach is highly structured to prevent the exact pitfalls we just outlined.
Let's look at the methodology behind her service packages, just so you understand what professional intervention actually looks like.
Now, let's break it down.
So it begins with a foundation audit. This is geared toward new business owners who need a readiness assessment. It's priced around $25,970, and it deeply analyzes your current exposure risk.
Right, looking at where your personal name is tied to business debt.
Exactly. It determined if you are actually in a position to benefit from a trust structure yet.
And if the foundation is viable, the next phase is an asset protection blueprint session.
Which is around R39,990.
Yes. This is the strategic mapping phase. It provides a customized structural recommendation tracing exactly how assets should flow between your trading company, your personal estate, and the proposed trust.
Which is so crucial.
It is, because the goal here is to map the transfer so you don't accidentally trigger massive capital gains taxes just by moving your own assets into the keep.
And for those ready to execute, there is the full Asset Protection Fortress setup. This is a custom-quoted end-to-end service. It formally establishes the trust, restructures the trading company's ownership, sets up the asset holding mechanisms, and guides the beneficiaries. But what really stood out in the sources is her emphasis on annual maintenance.
Yes, the annual maintenance is critical.
It's an ongoing option, about $47,900 a year. Because a trust is not a set-it-and-forget-it document. Tax laws update, compliance requirements shift, your business evolves. You need ongoing resolutions filed, continuous SARS compliance checks, and red flag detection.
Ongoing maintenance is what ensures the fortress walls remain impenetrable year after year. A static structure in a dynamic legal environment is a huge vulnerability.
So true. By the way, you can explore all of this and book a consultation directly through her platform at www.lemkensturman.com.
Highly recommend checking that out if you're in this position.
All right, let's do a rapid-fire recap of the architecture we've unpacked today. First, you must sever your personal risk from your assets. The company carries the risk, the trust holds the wealth.
Crucial first step.
Second, to deploy that wealth effectively, utilize the massive tax and social benefits of charitable trusts by securing PBO and Section 18A status.
The offensive play.
Exactly. And third, The legal and tax landscape is far too treacherous to navigate alone. Do not try to build this fortress by yourself. Utilize an expert trust consultant like Lumka to map, build, and maintain it.
This raises an important question. Exploring this architecture forces a profound paradigm shift for the listener who has spent their entire career deeply focused on growth.
Yeah, how so?
Well, you have spent decades obsessing over the question, how do I succeed? How do I scale this business? But as you reach the pinnacle of your enterprise, the question fundamentally changes.
It shifts to, what do you do with that success? I mean, material assets can be seized or lost. Markets can turn. Businesses, no matter how dominant they seem today, can fail. And what feels like a life-changing amount of capital to one generation often just feels ordinary or even expected to the next.
It just becomes the new baseline.
Right. But purpose. Purpose outlasts us all. The question isn't just what you are leaving behind in an investment portfolio, but who you are empowering to carry your values forward.
That is a real legacy.
Remember that financial tightrope we talked about at the very beginning? Building this fortress, and ultimately a charitable trust, isn't just about getting yourself off the tightrope. It's about building a stable bridge for everyone who comes after you. Something for you to mull over as you look at the structure of your own business empire today. Thanks for joining us on this deep dive.